talking about how savings and investing are not the same thing, right? We had an activity about that, that saving and investing were really not the same thing. They have the same end goal, but they're not the same process. That was our last response thing, was on that. So we're going to go into the differences. Now we're going into investing. You're always recorded, Glenn. You didn't know that? But I don't have your pictures on it. It's just me. That's how the notes get put in YouTube. You didn't know that? Oh, because I probably did it right in the middle. Okay, so first thing, why invest? Okay, why invest? First reason why we invest is to plan for retirement. Ultimately, that's the end goal, to plan for retirement. Okay. And in doing that plan for retirement, we pay attention to current laws, current tax laws, sorry, put the word tax in there, tax laws, to get added benefits for the plan. Okay, we talked about that. Remember, 401ks and certain IRAs will give you tax write-offs and tax benefits now, as well as helping you plan for your retirement. Okay? So the other thing it does is it helps you plan ahead. I can do this. Plan ahead and build a cash reserve of 3 to 6 months of expenses, regular expenses. Okay, that's the emergency fund. Okay, why is the emergency fund important? In case you lose your job, because life happens, right? And it's not always perfect, and things can go wrong. And it allows you to have something to live off of, because you don't want to be caught with nothing. Okay. Okay. Another reason why we invest is to have your money work for you by earning interest at a rate higher than savings. Okay, remember we talked about that since savings is so liquid, it's so easy to get to and you use it whenever you want, they give you the least amount of interest on it. So investing allows you to have your money work for you by earning interest at a rate higher than savings and inflation. Okay, we have to make sure we're we're making money at a good enough rate so it can offset, because we know the cost of things gets more expensive. It's just how it works. So we want to make sure we're making more money than inflation's percent so that the pool is big enough when it gets to the future dollar values. And we learned that when we did our retirement project, that a round of golf now might be $45, but when you guys retire in 30, 40 years, whatever, it wasn't $45 anymore. If you figured it out, I think it was closer to like $180 or more per round of golf. So if you want to be able to do some of these things that require money, you have to make sure you're earning enough money on your money, interest, that you'll be able to go ahead and fund it. Okay, we also remember that riskier investments, oops, that's not spelled right, investments are for long term, because in the short term, there are many ups and downs. Okay, so the ones, and by riskier we mean like startup companies and stuff. People did not go ahead and buy Tesla stock when it first got offered, planning that they were only keeping it for a year. They planned that they were in it for the long term. So some investments are intended to be, you get in, you watch it for a little bit, you get back out. They're less risky. A lot of those are your foundation stocks, like General Motors car company, right? Like, I think companies like FedEx now would be considered long-term. General Electric, that's appliances and things like that. Some of these bigger companies that have been around a long, long time, those are solid companies. Those are ones that you could jump in, be there for a little bit, take the upswing and earn some money, and then get back out again. But when you're looking at newer companies, innovative companies, companies that don't have a track record yet, you want to put money in and wait. You want to put money in and wait for a long time. We're talking years. Because on the short term, from month to month, it might look like you're losing money. But you've got to give them a chance to earn their momentum. Okay? So we're not talking about putting it into things that are unethical or illegal, risky. We're just talking about because they're newer, risky. They're in an industry that tends to have a lot of fluctuations, like the tech do. Okay. Last thing about this, there is no, and I'm going to put in colors, insurance to protect against loss, but the investment companies are watched over, oops, that's not watched over, by the Securities and Exchange Commission, which is abbreviated SEC, to keep them accurate and keep the trades fair. So some of you might have heard in the past against, oh, I think it's 2 S's, yep. In the past, okay, there's this thing called insider trading. And that's when a person with a company who knows something big is going to happen leaks it, tells their friends and family about it so that their friends and family could buy stock quickly in the company, and then make a big profit. It's illegal. If any of you know Martha Stewart, she has she had a cooking show. She has like home furnishing stuff, like sheets and stuff like that. She actually went to prison because she knew something big was happening with her company. And she told some of her friends and family, and they bought a whole bunch of stock. And they brought the price of her stock up even more. Okay. So insider trading is against the law. That's what the SEC watches for. Are you being accurate? Are you keeping things fair so everybody has the same benefit just because you know some information? Not fair for you to share it only with your family. Okay. So that's the SEC's job. Yes, people go to prison for it. So you don't want to, if you ever end up working in the industries, you don't want to do that. It's a nicer prison than the general prison. She went to a prison where like they had no real, she had to wear an outfit, but it wasn't like gang stuff. It was a cushy prison, but she was still confined, and it's still on her record. And she's no longer allowed to have any say in her company. It was taken away. So you don't want to do it. It's bad. Okay, now we're going to talk about the biggie. The big one that most people do their investing through is investing in stocks. And that's what you've been practicing on your project. Those that have done their project. Okay. First, we want to talk about what does that mean to invest in stocks. Stocks are certificates that represent a partial ownership in a company. Basically, by buying the stock, you are loaning them money. You're investing in them, you're loaning them your money to use. Now, we will be talking about when that happens. It doesn't happen when the average trading happens. There's a time frame in the company's life, so to speak, when that happens. Okay. Now, when you invest in stock, stockholders have voting rights. To elect board members, and it's a 1 vote per share. Who then, the board members, make the big decisions for the company. So they're the ones that look at everything combined, and they look at it and they vote and they decide, well, we own this piece of property that's sitting there vacant and it's not doing us any good. Would it be better for us to sell that? You know, they might have originally bought it thinking they were going to expand into that area, but expansion into that area doesn't make sense anymore. So should we sell that property and get that money back and use it for something else? Should we keep the CEO? Board members don't do campaigns. Basically, you get sent a ballot in the mail that says, these are the people we're considering for the board. Who do you want? So most of the time when you see the list, it's not even necessarily people you know. It's people they know. So what ends up happening is you look to see what the track record is. If they are already on the board and they voted, and like if they were on the board and the company's been doing better, then I would say keep them. They're on the board and the company's doing worse, I'd say we need some new people because they're not making good decisions, right? So it's that kind of thing. They don't necessarily campaign for the votes. Most of the time, the stockbrokers will just say, hey, this is the good one on the list. The people that are in the financial know. You would ask your financial manager and stuff. Okay. Now, stocks are issued and sold by companies to raise money for business operations, expansions, and other needs. So if they have a specialty project that's coming up, they might issue a new release of stock. Okay. So if you're a partial owner, but you got to think about the fact that remember in your project on how the market works, if some of you were looking, it talks about how much volume. That means how many shares there are of it. And if you look at some of these companies, there's millions of shares. And a lot of those millions of shares are little 10 here and 10 there with an average person. Okay. So stocks, we're going to talk about where stocks get handled. Okay, and that's called the stock exchange. And there's more than one. Okay, stock exchanges. Okay. On the stock exchanges, not all companies offer shares to the public. They only sell shares, to those they know. Okay, so it's when you're on the stock exchange, you're considered publicly traded, which means anybody who has money and can afford can buy. Not all companies do that. Some companies sell shares privately. They go to these people that they know, big investors that they know, and say, hey, we want to do this, this, or this. Would you buy in? Okay. So there are some not publicly traded companies, and some of them are big companies still. It's just, you got to think, when they're traded publicly, they're giving away part of their business. And maybe they aren't comfortable giving away part of their business to complete strangers, which is what it is if you're sold publicly, anybody could buy it. These are complete strangers to the company. So some companies want to keep themselves personal, so they don't go publicly traded. They get investments from and sell shares to private entities. Okay. And it's completely legal. Okay. It's not illegal to choose that you don't want to be publicly traded. No. Okay. You want to keep it a personalized business. And to do that, you want to know who your investors are. That's all it is. They're keeping it in-house. Okay. If a company wants to sell to the general public. Okay, and this is called go public. Okay. The first step, oh no, the first set, sorry, I read that wrong, of shares are called an initial public offering, abbreviated IPO. Okay, initial public offering. Okay. Nope. This is when the company gets the funds they are trying to raise. Okay. It's at that moment when they offer to, this is supposed to be so. They offer this big block of shares. That moment when they release those shares to the public, that first set that's purchased, that's when they get their money. That's when they've raised their funds in that moment. Okay. But as the shares are sold later, or I should say bought and sold later, there is no new money to the company. Okay. So they had these shares, they released them. When those got sold, that was when the money came to them. And then people trade them back and forth between each other, but it never comes back to the company. Because their first initial money that they got from that big block that they released to the market is when they got the money. They owned the shares at that moment. And that's when they got the profit from those shares. After that happens, the buying and selling around inside the market stays in the market. It's between the individual people that are buying and selling the shares. Okay. Transactions after the IPO, initial public offering, are the most common and are the ones you hear the most about. Okay. In the news, since they are happening in the secondary market. Okay. This thing we call the stock exchange. Okay. When you hear the Dow Jones went up this or stocks fell by that, they're talking about that secondary market. They're talking about, and that should be a T on the end. Okay, that's what they're talking about. That secondary market where the average person is putting their money. Okay. That secondary market is where the average person puts their money. There are a few stock exchanges. Let me see. Two main ones. Stock exchanges in the United States. Because there is Canadian Stock Exchange, and there is, all these countries have their own stock exchanges for the companies within their country. So the big ones we know about are for the US. Foreign people can purchase shares in the US. You can purchase shares. That's why on your game, you could be purchasing Canadian shares. It was one of your options. It says Toronto. It doesn't have on that game the ability to do the European ones, which would have been nice, but yeah. Okay, so first one, the first big one is the New York Stock Exchange. It is abbreviated NYSE. Okay, New York Stock Exchange, kind of straightforward. All right, the New York Stock Exchange is, let's see, I worded this differently. I'm going to rearrange it. Based in New York. This is an obviousness. The primary stock, they sell is, I wrote too small, so I have to bring it up closer. They have a focus that they do. Stable companies that have been around for a long time. I knew I wrote it somewhere. Now, by long time, there are companies on the stock exchange that have been there since the beginning of the stock exchange, which is the 1800s. General Electric. That's a big one. The car companies, those are big ones. So they're stable. They're consistent. There are some of the techs that are on it, but they're the older tech companies that have been around for a while. Okay. But there's another one, and that is the National Association of Securities Dealers. You'll see why they go by an abbreviation. Automatic quotation. They go by their abbreviation, which is the NASDAQ. Okay. The NASDAQ focuses on technology and innovation companies. Okay. These are considered riskier because many of the companies are cutting edge new technology, okay? Okay, the NASDAQ, abbreviations, is considered to be the home of the internet, biotechnology, and other cutting edge innovations. Okay. All right. We're going to go into a little depth in a second about the differences between them. Okay. Access to these exchanges is open to the public. So anyone's allowed to buy. Anyone with the money can buy in. Okay. And as you saw, there are some shares that are down, $30 a share, 25 cents a share. That's how come the average person can buy in, because the shares are not too pricey. Obviously, there's some of the shares that are way out there. Like Tesla shares are crazy expensive. Amazon's are kind of crazy expensive too. You have to save up to buy even one share. But there are some companies out there that you can buy 10, 15, 20 shares because they're only like maybe 15 bucks a piece. And in the long run, they'll make money. Are they going to make millions? Maybe not. But your goal isn't necessarily to always be making millions off one share anyway. Okay. You want to be making millions off a diversified portfolio. We're going to be talking about that. Many users access the exchanges through a broker, like there's Charles Schwab, let me think of who else, or internet accounts with traders, and that's like Robinhood. Okay, those are considered brokers. All right. Difference between these two, though. With a live broker, like Charles Schwab, it's a person, okay, with a live broker, they usually offer advice on good purchases and will research, that's not the right advice, and will research various companies for you. It's part of their service. Okay. With the internet brokers, like Robinhood, like Acorn, like that. They offer less advice So you need to do your research. Okay. Oh, I needed to add up here. They do advise on good purchases and will research various companies for you, but have high fees. You pay them an annual fee. You pay them a % of the sales. There's various ways that they could do it. I mean, obviously, they're needing to be paid for their services. So the way they do it, sometimes they charge a fee, sometimes they get a percentage of the sale. Okay. With the internet brokers, they offer less advice, so you need to do your own research, but their fees are much smaller. Because they're doing less, obviously. You would expect it to be smaller because they're doing less for you, okay? Okay, now we're going to talk a little bit about the differences between the New York Stock Exchange and the NASDAQ, okay? New York Stock Exchange. A bell is rung at 9 a.m. Monday through Friday, except holidays. Oh yeah, they take the holidays. Okay. And then everything goes into chaos, or looks like it to the outsider. As representatives, can't spell. It wants me to put "and" in here, to an outsider. As representatives for the brokers, I'll start yelling out their orders to each other. So picture a massive live auction with multiple the guy that goes 3 7 yeah, I'll take 4 5 yeah, he's now 7. They're doing that, but picture that with multiple people doing that to each other. That's what it is. So if you've ever seen one of those live auctions where it goes, bidder number 7, he's bid 5. Do I have 10? Do I have 10? Do I have 10? Do I have 10? Do I have that thing? But we're talking about hundreds of people yelling out their order, someone else hearing it, wanting to buy, bouncing back and forth. It is crazy. If you, in one gigantic room, yes, multiple auctioneers. Thank you. That's what I was going for. Okay, one gigantic room, multiple stations, but it's a gigantic room. I mean, like the size of a stadium kind of room. Okay. Because it's a live auction that's going on. Okay. Orders to each other. Oh, not others, each other, singular. Okay. It is a massive live auction is what's happening, auctioning off the shares of the companies. Crazily, it works well as a system for the buying and selling of shares on the secondary market. That's what they are. They're the secondary market. I love grammar check and hate it all at the same time. Okay, how this works. You place your order to buy or sell with a company, to buy or sell stock for a company that is listed. In other words, they're represented. They are publicly traded. And that order goes through the chaotic market and it is carried out. So you place your order, I want to buy, the craziness happens and the purchase happens. You place your order, you want to sell, the craziness happens and the sell happens. So when they're on the floor, there are people there whose job is sell, and there are people there whose job is buy. So they've got the list from their broker saying, these are ones we want to buy. These are our companies that we've recommended to our people, and we want these purchased in these amounts. So their job is to yell out, I want to buy, 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 buy. And they're telling people they want to buy stuff. So then the sellers are listening for these people that are buying, and they try and make a connect. But it's a big craziness. It's a big craziness. Okay, so that's the New York Stock Exchange. NASDAQ, however, NASDAQ is different. Okay, the NASDAQ is different, and it was different on purpose. It does not have a central location. For the dealers to gather. Okay. It is an electronic, network of dealers. Okay. So they're buying and selling electronically to each other. So it's not this great big room of chaos. Okay. Both exchanges Harley publish prices for the stock on their exchange so that trades can be made and investors can follow their investments. And that's if you go, and I'll show you in a second, their investments. Yes, I'm going to show you really quick. You kind of saw it a little bit in how the market works, but I need to get another. Say you have, can you see this? Right? Yeah, full of New Yorkers yelling out. The New York Stock Exchange is both primary and secondary. The predominant portion of the New York Stock Exchange is secondary because that's where people are buying and selling and trading every day. But they are primary also because that is where the initial offerings go, the IPOs get made out to. So you guys can see the internet that I'm on, yes or no? Do you see the notes or did you see the internet? Okay, so this was the New York Stock Exchange today. Notice it has this little thing here and it's telling us what's going on. So today, 16 million, because this 16,000 they're showing here is actually millions of shares were sold today up until 4 p.m. Throughout the course of the day, see, some rise, some fall, some good, some bad. But it looks like they started today low, went up for a little bit, and then they came back down. Okay, so you can go ahead and request, right, that this thing, there it is. I don't want to do that. You can go ahead and set it up, like especially if you're with Robinhood or something like that, that it sends you alerts when your stock goes below a certain value. Stock market, let's go like that, stock market news. And whenever you kind of see, you're watching the news and you hear about how this business offered an IPO or that business, market watch stuff. So see how it's telling us. These are various subcategories within the market. Notice there was the NASDAQ. This is the NASDAQ all by itself. But like the Dow, there's certain companies that fall into the Dow Jones Industrial. Oh, look, there's Europe and Asia and stuff on here. That's kind of cool. But it's telling you what's going on with the market, what's going on with those stocks. You could go ahead and look up specific stocks individually and watch to see, is that going up? Is that going down? Okay, so they post these prices and stuff so people can keep track. Look, gold is selling at $1,900 for 1 ounce right now. That's crazy. Let's look at Tesla. Oh, that's not too bad. 1 share of Tesla stock is only $604. Look, for a while there, it was way up here. So there's different ways you can look at it and keep track of it and stuff. But they have to publish those prices so that your investors can keep track of their investments. Okay, any questions? Go ahead and turn it in. We're going to do a part 2 tomorrow.